lot of people are probably asking the same questions right now. What's actually working in this market? What's not? So I looked through my scan on the biggest US companies and I sorted them here. I looked at which stocks were closest to their 52-week highs and which ones were furthest away from it. This is what I found. So we'll take a look and start with what's working and what's showing relative strength. Off the bat, what I noticed was there's strength in consumer staples, so brands that people will typically buy no matter what. So think McDonald's, Coca-Cola, Procter & Gamble, Philip Morris. These companies have pricing power. They're stable, cash-flowing companies, and they have global reach. So whether the economy is booming or slowing down, people are going to be eating Big Macs, drinking Coke, brushing their teeth, and they will for sure be buying cigarettes. Now, we also have some financial names in here, but nothing too risky. So Berkshire Hathaway, Progressive, and Arthur J. Gallagher. CME Group, which they run one of the largest exchanges in the world. So they're going to be making money. These are all cash flowing machines. We're also seeing some strength in utilities. So names like Duke and Southern Company, and also in healthcare, you have United Health. That's a giant in the medical insurance space. So these are names that are not hyped. These are not hype names. These are solid balance sheets. They're dependable earnings, and they're usually recession-proof demand. So let's take a look at what's not working now. And this is where it gets interesting. This is all the stuff that was working before. So we're looking at tech, semiconductors. They're all getting hit hard, like Marvel, Micron, Dell, AMD. Even the big software names like Adobe and Oracle are well off their highs as well. And it's not just tech. It's Tesla's here, Nike's here, UPS is here. And there's names like PayPal and MicroStrategy, who are fintech and crypto related too. So I think the market is giving you a pretty good idea on where the risk appetite is right now. I think it's trying to tell you less speculation and more consistency. It's the same story, I believe, in the bonds market. In SHI, the ETF, which holds 1 to 3 year treasury bonds, could be telling you that for now, investors are moving into short-term duration safety, short-term, a little less aggressive and less speculation to the upside. So bottom line, the money isn't necessarily fleeing from the markets, but definitely feels like there's a rotation. They're moving into brands with durability, businesses that make money in all environments, and stocks with solid, predictable earnings. So the playbook here, I think you really got to stick with names that are dominant in their industries, and this should always be the case. Avoid the hype names right now around tech until the market really starts proving otherwise. Watch and wait for bases to form in these tech names before trying to catch the fallen knife. These names could still go further lower from here. And above all, just follow where the market is actually moving. That's all I got for now. If you want to see this kind of breakdown week to week, drop a little lightning here in the comments. Keep trading smart and stay on the right side of the rotation.